Welcome to This Explainer. Today, we're putting Lloyds Banking Group through the ultimate stress test. We're going to take their incredibly strong Q1 2026 data and run it straight through the legendary investment frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, plus some pretty hard-hitting cash flow models. If you've been watching the UK banking sector, you already know Lloyds has been printing some serious numbers lately. But does a single strong quarter actually make for a smart, long-term investment? Well, let's find out by putting the stock through the guru gauntlet. So here is our roadmap for today. We'll start with a quick company snapshot, then we'll look at the stock through the Buffett lens, the Lynch lens, and the Graham lens. After that, we'll dive into DCF and a few additional models before finally wrapping it all up with our synthesis and final verdict. All right, part 1, company snapshot. Let's ground ourselves in the present reality of the business. The most crucial thing to understand right off the bat is that Lloyds is entering this gauntlet from a position of absolute strength. Sitting at a current price of 112.15p, the bank just posted a Q1 2026 net income of £4.8 billion. That is a really solid 9% jump year over year. They're also flexing a super robust Common Equity Tier 1, or CET1 ratio of 13.4%, which sits very comfortably above their 13% target. And honestly, perhaps most impressively, they're generating a massive 17% return on tangible equity. Seriously, these are exactly the kinds of numbers that make value investors drop everything and pay attention. Moving on to part 2, the Buffett lens. Let's see how this builds a picture of qualitative and quantitative strength. Now, notice the intense operational discipline highlighted here. This is exactly what Warren Buffett hunts for. Just look at the controlled operating costs holding steady at £2.5 billion, coupled with a remarkably low asset quality ratio of just 25 basis points. It perfectly illustrates Buffett's deep desire for honest, disciplined management. I mean, when a management team can keep costs tightly managed while actually expanding margins, like how their net interest margin pushed up to 3.17% this quarter, it shows they're successfully defending their economic castle. When we actually quantify this, Lloyds passes the core Buffett criteria with flying colors. Their economic moat is firmly established through a dominant UK digital banking network. Earnings are growing consistently, and that 17% return on tangible equity? Just excellent. Debt is totally manageable too, especially when you weigh their £114 billion of holdco subordinated debt against that robust CET1 capital. And if we look at underlying profit as a proxy for owner earnings, we are seeing about £2.0 billion generated in just this quarter alone. But, and this is a big but, Buffett is famous for protecting his downside. Even with a truly wonderful business, the Oracle of Omaha would absolutely demand a 20% margin of safety to cushion against any macroeconomic curveballs. Because of that, he'd likely wait patiently for a dip below 90p, specifically targeting around the 89p mark before he'd actually pull the trigger. Okay, let's pivot to part 3, the Lynch lens, where we search for growth at a reasonable price. Peter Lynch would instantly slap the stalwart label on Lloyds. It's a massive, deeply established financial institution. Look, you aren't buying Lloyds expecting the stock to quintuple in size overnight. Instead, you're buying it for stability and a highly reliable dividend play, which currently gives us a prospective yield of 4.6%. Now, what gets a Lynch investor truly fired up here is the PEG ratio. To find this, we divide the price-to-earnings ratio by the earnings growth rate. With a PE of roughly 11.3 and a frankly massive projected EPS growth of 41%, jumping from 7.0p actuals in 2025 to a consensus 9.9p in 2026, we get a PEG ratio of 0.27. Anything under 1.0 is considered phenomenal in Lynch's playbook. The balance sheet is also rock solid with that 13.4% CET1 ratio. And while insider buying data isn't explicitly detailed in our source files, so we have to assume a neutral stance there, we can assume high institutional ownership given it's a major UK bank. Ultimately, this incredibly low PEG ratio, combined with a healthy dividend, makes it a wildly attractive Lynch stalwart. His verdict? A rock-solid hold, or even a buy if you're specifically hunting for reliable yield. Let's step into part 4, the Graham lens. We're stripping away the sentiment for a pure defensive mathematical check. Benjamin Graham is all about that strict defensive investor checklist. And wow, Lloyds just sweeps it. Adequate size? Yep, it's one of the absolute largest banks in the UK. Strong financial condition and earning stability? Absolutely. An uninterrupted dividend record? Yes again. But the real make-or-break jest is his valuation limit. Graham basically stated that a stock's price-to-earnings ratio multiplied by its price-to-book ratio should never exceed 22.5. So if we take Lloyd's PE of about 11.3 and multiply it by its forward PB of 1.30, we get 14.69. That is well beneath Graham's 22.5 limit, meaning the stock safely passes his ultimate defensive value screen. This brilliantly sets us up to use Graham's core valuation formula to find the intrinsic value of the share. The formula is simply the square root of 22.5 multiplied by the earnings per share multiplied by the book value per share. For our inputs, we're going to plug in that 2026 EPS consensus of 9.9p. And for the book value, we'll use the highly relevant tangible net asset value per share, which is currently sitting at 57.9p. Running that math gives us an intrinsic value of 113.56p. Now contrast that with the current market price of 112.15p. To Graham, this means the stock is practically at fair value right this second. But remember, Graham was notorious for demanding a huge margin of safety. We're talking up to 30%, before he'd even think about buying. So while the math says it's fairly priced today, Graham would almost certainly set a limit order all the way down at around 79.5p just to guarantee his buying $1 for 70 cents. Moving right along to Part 5, DCF and additional models. This is where we let the raw math do the talking. To build our discounted cash flow model, we do have to make a few standard assumptions since our source data doesn't explicitly hand us a discount rate. We've assumed a standard 10% weighted average cost of capital, or WACC, to discount future cash flows and a pretty conservative 2% perpetual terminal growth rate, which acts as a reasonable proxy for long-term UK GDP growth. If we project out that impressive consensus EPS growth over a 5-year forecast period, it gives us a base case fair value of roughly 125p. So based on cash flow alone, this suggests the stock is currently about 11% undervalued. But, as you probably know, DCF models are wildly sensitive to your assumptions. This sensitivity table shows exactly how drastically that intrinsic value can swing based entirely on your view of the macroeconomic world. If you demand a higher 12% return to hold the stock and you believe terminal growth stalls out at 1%, the fair value absolutely plummets to 100p. On the flip side, if you think the discount rate should be lower, say 8%, and growth pushes up to 3%, well, you could easily justify a price of 165p. It really all depends on your outlook. Let's tackle this from another angle, the dividend discount model. The analyst consensus from our sources highlights a massive projected growth trajectory for dividends. We are talking about leaping from actuals of 2.43p in 2025 all the way up to an incredible 6.12p by 2028. Factoring in this aggressive dividend expansion, our model actually suggests a highly attractive fair value closer to 140p. For income-focused investors out there, these projections make a seriously compelling case. However, we always have to look at the bear case, right? And applying historical multiples paints a much more cautious picture. Currently, Lloyds has a forward price-to-book ratio of 1.30, but its 10-year average is only 0.85. If market sentiment shifts and the bank reverts back to its historical 10-year average price-to-book multiple, it would crash the implied value way down to just 49.2p. Similarly, reverting to its historical average dividend yield of 5.8% implies a price hovering around 85p. This really puts a spotlight on the valuation risk present in the market today. All right, we made it to Part 6, synthesis and final verdict. Let's bring all these disparate numbers together. Bringing all these different methodologies into one master table reveals the ultimate tension in valuing Lloyds right now. On one side of the coin, forward-looking models based on cash flow and those exploding dividends suggest Lloyds is actually significantly undervalued today, pointing to price targets ranging from 125p up to 140p. But on the other side, our defensive gurus, Buffett and Graham, are basically saying there is zero margin of safety left at the current price, and historical multiple comparisons are practically screaming caution, warning that the stock could be vastly overvalued compared to its own past. Breaking it all down, the strengths of the actual business are undeniable. We are staring at a sky-high 17% ROTE, fantastic excess capital, and really robust near-term EPS growth. The business itself is firing on all cylinders. But the main risk isn't the daily operations, it's the price tag attached to them. The valuation is stretching way past historical norms, and you have to weigh that against the updated economic scenarios in our source data, which are actively modeling for potential macroeconomic shocks like rising unemployment and tightening commercial real estate prices. So, blending all these amazing insights together, our final verdict at the current price of 112.15p is a solid hold. The fundamental business is undoubtedly thriving, but as an investor, you're paying a pretty hefty premium right now for that greatness, and you are entirely lacking that critical margin of safety that our investing legends demand. If you already own it, enjoy that sweet 4.6% yield and hold on. But if you're looking to start a position, the smart play is to follow the gurus, set those limit orders around 89p if you're vibing with Buffett, or down at 79.5p if you are a strict Graham defensive investor. I'll leave you with this provocative thought to ponder as we wrap up this explainer. If the dividends really do more than double by 2028, just like the analyst consensus predicts, can you actually afford to sit on your hands and wait for Graham's strict 30% discount? Or in a market that's incredibly hungry for yield, is the true risk simply sitting on the sidelines and missing out entirely? Thanks so much for joining me on this deep dive. Let the numbers guide you and keep learning.